Welcome to Unstoppable Real Estate Investing Wealth. My name is Billy Alvaro, aka the Unstoppable VA, former billion-dollar mortgage banker, gone bankrupt, turned professional real estate investor. Where each week you'll learn the tools, strategies, systems, and secrets myself and other highly successful real estate investing entrepreneurs use to start, grow, and scale their businesses, creating massive profits, and how you can too. And we'll teach you how to put those profits to work so you no longer have to. Get ready to finally experience financial freedom and generational wealth. Now let's get started. What is going on, everybody? Welcome back to another episode of Unstoppable REI Wealth. I'm your host, Billy Alvaro, the Unstoppable VA, and I am on today with two gentlemen, East Coasters like myself, not New York, but close enough. They're up in Massachusetts. These gentlemen are in the space of apartment investing. Now, if you've been watching me for a little bit, you know that I have a fond desire to start getting into their space. So I'm going to take this time to pick their brains, figure out what the hell they're doing, how they're doing it, how they're so successful. Welcome to the show, Eric and Nick, and the company name is Winter Spring Capital. Welcome, gentlemen.
Hey, thanks for having us.
Absolutely, absolutely. So listen, you guys have been partners in this business for how long?
Started in 2015.
And what was your background, gentlemen? Were you fix and flippers, wholesalers?
I got my real estate license out of college, so I was selling mid-sized apartment buildings for a few years. Come from a construction background. My brother's a carpenter. My father's a contractor. So kind of always been in the real estate world. Eric and I have been friends for almost 20 years now, met each other when we were kids. So I had the real estate background to start with, but Eric comes from the finance world, which, as I'm sure you know, is also very helpful in real estate.
Absolutely. And Eric, what about yourself? How long have you been in the finance world?
Yeah, so when Nick and I met in high school, and then we kind of went our separate ways for college. And I was working in New York City. Right out of college, I was trading stocks. I was working in public equity, and then I started working for a firm that dealt with private equity, kind of private equity information services. And that was so I kind of got the financial background. So I went to school for originally engineering, and I kind of switched halfway through when one of the professors said, the guys who make the most money aren't sitting in this room right now. And I said, okay, I got to kind of change my, that was like a ding moment for me. But Nick and I always knew we wanted to do something together since high school. We didn't want to work for someone else. And, I always tell Nick, it's like the first minute I sat down at my first job at 9:01, I said, there's no way I can do this till I'm 60, like 1 minute into the job. So,
yeah, listen,
so
some people, they're cut out for it. And some people, they're not. And obviously, you're cut from the cloth I'm cut for. I can't work for somebody else. I can't be in that mundane 9 to 5, same thing every single day, punching the clock. Like, how old are you guys, if you don't mind me asking?
I'm 32. Eric's turning 32 soon. He's 31.
You guys are young and in your prime, man. This is good.
That's what they tell us. Yeah.
I love it. Yeah, you guys are primed to just like rocket ship take off. So let's get into the business that you're in today. You guys joined forces how long ago? A couple of years back?
Yeah, 2015 we started our company, did our first project.
Good. In 2015. And so give us the story of how you guys formulated and said, you know what, Nick, Eric, you guys are talking, you guys have been high school friends forever. Like, we want to do this business. How did you come up with this model of going after and investing in apartments? I know Eric is a finance guy, you're construction, but why didn't you start with single family? Why did you make the jump right into the multifamily?
It's interesting because our original plan was, hey, let's save up some money for a few years and buy a rental property and just kind of go down that traditional path.
The slow way.
The slow way, yeah, exactly. The painful way, you could say. But what we saw here in the market we're in Boston is, it's either the number one or the number two life science market in the country right now, up there with San Francisco. And in the past 10 years, you've had this huge influx of high-income workers moving into a city with very restrictive zoning. So we're not really able to keep up with the demand, which has led to prices skyrocketing. Yep. So we wanted to buy a rental property, but we saw this because I was in real estate sales at the time. We saw this opportunity to develop condominiums. And that's what we've been doing ever since. We've since added, apartment conversions, and we're doing an affordable housing job. But Boston is a really good market for condominium development just because a lot of these high income workers, you've got a good luxury rental market here, but a lot of them want to own their unit. So they want to buy a condominium, but they still want to live in a dense urban center. They still want all those conveniences. They don't necessarily want to live in the suburbs. So we've been selling condominiums to people like that ever since. Our first project was a 2-family, which, according to the zoning code, you could add a third unit. So we took that 2-family, fixed it up, increased the size of it by about 40%, added a third unit, and then sold them individually as condos, and just kept kind of rolling our money back into new projects. And over the years, as we built up a reputation, we started picking up investors. So that's been our bread and butter since 2015.
Smart. That's a pretty cool niche. And so you're going in ground up. Are you knocking down something that's already on the property, or that seems to be your method?
Yeah, it really, it's project to project, depending on where we can add the value. But I'd say at this point, almost all of our projects are knocked down, ground up, new construction. We did last year. We finished like a historical renovation. It was just a 3-family, really big units in a really nice part of Boston. So those sold like almost $1.5 million a piece, those condos. But that was a very tedious renovation. It was a historical building. We couldn't knock it down.
Yeah,
So rare
tough.
situations like that, we'll keep it. But most of the time, knocked down, ground up. It's actually an easier process for us.
What's it like to go out and to try to search for properties that you guys know you could either change the zoning, or the zoning's currently there, but the property that's on it is not up to its highest and best use? Like, what is that process like? How are you looking for like a needle in a haystack trying to find these properties?
Definitely a needle in a haystack sort of situation. So a lot of times what you'd call them would be urban infill projects, where you're in a 2-family or 3-family zone. And we right now we're doing a 32 unit, a 31 unit. So we've kind of scaled up, but this is what we had been doing for years and kind of got us to this level. Is you'd go to like a 2 or 3-family zone, and you'd find a lot that's maybe double the size of the typical lots there. And you'd propose to build 7, 8, 9 units. And, you'll go through a community process. But getting back to your point, finding the lots, it is a needle in a haystack thing. You want to find particular lots that are, generally speaking, oversized for their zone. And those are the projects that we started with, going to zones like that and creating value where others didn't see it because we go through entitlement.
So what is that process like? Because I know what it's like on the single family side. We can narrow down and really look at our list and hone in on the type of person we want to target and the type of property we want to target. Are you guys doing something similar in your space, where you're getting a list and really honing in and finding out, those top 100 properties that have the highest and best use that you guys can go after?
Yeah, it's kind of been an evolving process, Billy, over the years of doing this. Where early on, we didn't really understand this concept of connections and really how to build out your network and have deals coming to you that are off market. So we were looking on, the listing service, multiple listing service, MLS, for our region, and kind of, we'd look at multifamilies. We'd kind of put in a price cap based on, where we were at that point. And then the process kind of evolved where we still do that, but there's a lot of guys who are coming up kind of behind us or similar, peers to us, where there's a lot of competition for stuff that's on market. So we really bought into, and it kind of was organic, this kind of building our network. Well, like I said, we didn't really realize or buy into it at first, but once we did, we now are at the point where, the best deals we get have come to us from either brokers, off market deals, commercial level properties that, aren't even really on the MLS sometimes. And I'd say, even a few of them, we have big lists of off-market deals. Well, when I say off-market, I mean not even deals, just people who own a house, for example, that we know, okay, it's in this zone. That zone is very favorable for this, this, and this.
Got it.
Let's call these 500 people. We got a few that way too.
Got it. So you have a dual process to get it. In networking, people sometimes knock it and like, hey, marketing is the way to go. Man, networking, you build your network, you get free deals coming in like left and right. Do you guys have a process for networking? Like, are you intentful with the way in which you network to drive in business?
We have a third partner, kind of like a junior partner. He joined the company a couple of years after us, but another friend of ours.
Keep that guy off. We don't have room for a fourth, man.
I know, right? Yeah, we can't keep splitting the pie too many times. But he's kind of like a full-time networker. So he deals with investors. He's gotten off-market properties. He tries to build the brand on LinkedIn and other areas just to get the word out about our company. And we've gotten deals that way. We've got off-market deals that way, and we've met brokers that way. And then, like as Eric said, a lot of it's organic, just being in business for however many years now, 6-7 years. We've done a bunch of projects. People have seen our work on social media, or they've seen it in person, literally in the market. People know us. We have past investors. Over time, people just start messaging us and saying, hey, I see you're doing this. Do you have any other deals you're looking for? Now I get messages from brokers, and I don't even have to try to network with them. People are messaging me on LinkedIn, emailing me. I don't even know how they got my email. It's all just from putting our brand out there and, doing good work. You had a bunch of successful projects, you'll build a reputation, and deals will come to you. So it's been nice.
How long ago did you bring on the third partner?
Just over 2 years ago now.
Because Eric, when I asked the question about if you guys, is there intent behind the way in which you're getting your networking done, I saw you shaking your head no a little bit, but honestly, you really do have a process, because this third partner is your key to developing outside business. He's the guy. You guys might not be focusing, but that third partner is, and I guarantee he's intentful with the way he's marketing. He's putting out his text, his media posts, and bringing these people in. So key. That's a key takeaway I want the listeners to have here. If you're going to be networking, in the beginning, it might be organic. You don't know what you're doing, but if you put some intent behind it, you're going to get some serious results, as Eric and Nick have with their third partner, who I'm assuming that's probably his primary focus is business development.
That's a good point, because it's actually, we kind of looked at it as, okay, we need to market. He needs to get our name out there. We need to market. We have a social media girl who works for us, and she posts a bunch of stuff on our accounts and our thought was we need to get our brand out there for investors so that we can bring on investors to the project. But it's kind of had a two-prong effect where now, because of that, because we were so intentional about that, the deals have come too, because just by sort of marketing and getting out there looking for investors, tons of people you interact with, maybe they're not investing, but they have deals of their own. So that's actually a good point, Billy.
Yeah, I love it. You guys are doing the right thing. So give us an idea of the projects that you're doing currently. I know, Nick, you said that you have a 31 and a 35 unit that you're in the process of developing out.
Yeah, so we have a ground up luxury condominium building right in the heart of kind of that life science sector part of Boston, 5 minutes from Harvard and MIT. That'll be 32 units. It's going to have some real nice amenity spaces, gym, co-working, lounge, roof deck. So that'll be a high-end luxury condominium building. So we'll be selling all 32 units. And then outside of Boston, kind of a more affordable satellite city called Lowell, we're doing an office conversion to apartments. So it's an existing office building, and we're converting it into 31 apartments with 5 first-floor retail tenants as well. And that one will also have like a gym, nice roof deck. So one's a rental, and then one is going to be sold as condominiums.
Got it. So the affordable piece is rental. So I want to actually take some time, because this is going to be good to show and showcase your expertise to the listeners. I want to use these two as case studies, right? I want to get into you and pick your brains to really give my listeners some takeaways of how you guys think through the process to come up with your numbers. So my question is, I know what it's like in the single family world. You see either a piece of land or you see a property. We can calculate very easily, figure out what the after repair value is, know what our construction costs are, and then come in with an offer based on what the risk is and what kind of returns we want. My question to both you, and you guys could break it up, Eric and Nick, the first property, the higher end luxury ground up. When you're going in, you're looking at this property to make a bid. How are you guys determining what you could offer on the property if you don't yet know what all your costs are? Like, how does that process work?
That's a good question. So we look at it and we say, okay, there's 32 units here. And for example, in this one, it's actually 4 of them are affordable units per city requirement when you get to a certain size.
Yep.
So we know right away, okay, those 4, we know what they sell for. There's a specific price they have to sell for. So of the remaining 28, we look at comps in the area. We look at condos that have sold, and there's tons of them in that area, which is why we were interested in the first place. And we see, okay, what are they getting per square foot? In this area, very high price per square foot. And we say, okay, each of our units is, 900 square feet. They're getting this much per square foot. We know those 4 affordable. So across these 32 units, we could sell this thing out for X, right? And then we say, okay, we know the square footage of this building. We know roughly the construction cost per square foot to build something. So then we just multiply that and we come up with, okay, so this is the total cost to build this thing, hard cost wise. Then we look at, okay, if that's the cost to build this thing, and that's what we could sell it for, one more component in there would be kind of like soft costs. So we kind of know those roughly per foot. It's hard costs a little easier, meaning, true construction costs, your contractor's costs a little easier than soft costs because those can vary. But you work in based on our estimates, soft costs, legal fees, architecture fees, and then we work in interest. Once we see kind of this total cost, we can calculate interest based on what a loan might be. So now we know, okay, the total cost for this thing would be this before we get to a price, and we can sell it out for this. What kind of profit margin could we live with, and would a bank finance? And then we kind of just work backwards, land on a price, and that's kind of a very high level overview of how we would do it.
So it makes sense. So it's very similar to the way we would do it on the single family side. Sure. It's just a few more different numbers that you have to pull in and do your calculation. Eric, with that regards, when you're figuring out your overall process, how long do you take into consideration? Well, first question is, I'm sure you're buying this subject to, so you know that you can get the amount of units that you want to get in, or are you guys just buying the dirt and rolling the dice?
It varies. If we see a really good project where we think, look, we could get this thing through zoning, there's a lot of precedent in the area. We're only going to try to go for, say, 10 units, and we see 20 unit building down the street, another 15. We might take that gamble. But the gamble would come with a caveat that worst case scenario, what we could do within the zoning code by right would still break us even. So there's never going to be a situation we couldn't do something. But we do love contingent deals. Obviously, it's much better for us.
Yeah, smart. And in your neck of the woods, how long does it take once you get through the entitlements to actually break ground? I'm up here in New York, and I got to tell you, we have a project of 48 unit that we've been working on 3.5 years trying to get this through to get the entitlements. It is a pain in the ass.
Brutal.
Yeah. Brutal.
Probably not too different here. I mean, we've got ton of red tape. Bigger projects and mid-sized projects can take 3-4 years. The smaller ones we've gotten lucky where we've gone through in 6 months getting a project entitled, and then we've had other projects where we were in permitting for 2.5 years. So
crazy.
Yeah, it is not. You can't control the city employees' response time.
I know it's a pain in the ass. So when you're doing that, then back to Eric on the finance side, I'm assuming you're not closing until you have all your entitlements in to where you can break ground. So you really have no holding costs. You just have your money that's hard that went down on the property. Is that right?
Again, it does depend. I mean, there are times where we've had to hold on to properties and pay holding costs that entire time. So it has to, for that to happen, it has to kind of be a home run. You know what I mean? Yeah. We have to know, okay, look, we're willing to eat this cost. So if we take on investor capital, we're gonna, say up front, hey, look, this is the amount of time it's going to take. There's soft costs, meaning carry costs, pre-construction soft costs that we have to fund. So we're going to raise for that as well. Yeah. At that stage.
And when you do that raise, Eric, are you telling your investors up front, look, this is all going to be deferred until we start selling these things off? There's going to be no interest payments?
Yeah. So for our condo project, since we're kind of in that niche, we look at a realistic time frame for the investors. We say, hey, look, this is going to be a balloon payment at the end of the project, and as soon as the loan is paid off, the next step is paying you guys all your principals, and we, as units sell, because they're condos and they'll sell individually, we'll continue to pay you guys back, and we usually give a preferred rate of return, kind of a total preferred rate of return over the 2-3 year time frame, and we pay them all their principal, pay them that preferred rate of return, and then we can start partaking in the profit. So they know going in it's going to be a delayed.
Got it. So you have a delayed process on your financing. You're giving them no equity share on the upside?
It depends. We have, but we found for a lot of the guys who invest with these condo specific deals we do, they kind of prefer this structure better.
That's good. And what kind of preferred rates of returns you guys offer to your investors in projects like that?
Again, it varies on we estimate the risk, and the time frame and everything. But I'd say, say a typical condo project, 2-3 years, we might say, look, we'll give you about maybe 50% on your money preferred at the end before we, touch anything.
So it's a decent return. It's a
Absolutely.
real, it's a real serious kicker for sure. That's a great way to do it. So you take it on a partner like that. This is good. So now I want to switch gears, right? I mean, the first case study we went over, very similar to the way we do it on the single family side. Construction costs, whether it's a property, you're looking at your soft costs, your hard costs, your financing costs, putting it all in, assessing your risk. Now let's switch gears and talk about the one where you're doing a conversion, because this is where I would think it's more of and I could be wrong, but I think it's more of a higher level. A lot more assumptions have to go into this because you have a building that's as is that you now have to come in and try to figure out what the hell is it going to take to convert this thing. Walk us through that process, either one of you.
Yeah, so what we did with this one is we put in an offer with a due diligence contingency, and that basically says from day one we're going to be walking through here with our contractor and architect. So we'll bring the architect in, after we put in an offer. Obviously, we do pretty much the same process Eric described before we submit an offer, the pencil test kind of. But then, as you said, there's a lot more unknowns with this sort of project. So then we want to kind of sharpen the pencil, bring in the architect and the contractor. We want to be able to walk away from this deal if any of the assumptions we made were wrong. And, an owner could reject a contingency like that, but usually people understand. You're going in and converting an existing building. So they go through, the architect will draw up how many units you can get. We'll go back and forth, kind of tweak it a bit. And then the contractor will look at the plans, he'll walk through the building, and then he'll give us a price. So we'll kind of know all that ahead of time with the ability to walk away if anything's wrong. So we eliminate the risk just by having a simple due diligence clause. It is more complicated, though, because our goal with these buildings is to be able to add value and then refinance and hold on to them. Right. Whereas, just selling them, it's a lot simpler. So we look at, when it's stabilized, how is this building going to perform? So we look at similar buildings that are old, historical, nice buildings that have been converted into apartments. And we look at similar, what their rents are for a building with similar amenities, similar quality level. And then we'll look at what their expenses are. A lot of times you can get that from CoStar. Maybe some of those buildings similar to yours are on the open market, and you can look at their offering memorandum, get that stabilized expense data, get that stabilized revenue, and then you just plug that in based on the plans your architect drew up. We need to do all this in order to get the project financed to begin with, because we have to show the bank, how is this building going to look? And then this deal is actually even a little more complicated because it has historic tax credits involved. A lot of these buildings in Massachusetts anyways, just because of the industrial history here in the 1800s and early 1900s, a lot of them went through a period of not being used and kind of becoming dilapidated. But in the past couple decades, the historic tax credit program has created strong incentives for developers to go in, fix up these buildings, and then the government will provide you with additional subsidy through the form of a tax credit, which you then sell to an investor who has a high tax bill. So that's a whole other ball game that we've only recently kind of wrapped our heads around, and we work with consultants that help us with that. But that's another element to these conversion sort of deals.
Yeah. Yeah, you're learning as you go. So when you guys first started getting into, I know you had your smaller projects that you did, and I know Nick, you said, in this particular deal, you had your assumptions that you made up front, and you brought in your team, your architect, your contractor. What if you don't have any historical data to plug into the spreadsheet? What in the hell would you do? Would you just skip that and go right to letter of intent to purchase the building with the due diligence, and then jump into, your architect and your contractor and hope for the best? Like, what would that look like? You had no experience. You were going in, you had no assumption, no previous experience and assumptions to put into your spreadsheet in the beginning.
Yeah, we'd probably do a longer due diligence period and see if we could get that accepted. If we really had a good feeling about it, and that was almost it, we just had very little data or no data, we might have a feel about just kind of the general market, and we say, okay, look, we know people are starting to move there. People are renting there. Because again, these conversions are rentals, not condos. We're going to try to hold on as an asset for the long term. So that's what we would do. We'd probably put in an offer with a heavy due diligence period, hope it was accepted. If not, they probably counter, and then we kind of weigh all the options, say, all right, is this worth it to take this sort of higher counter that they want to do based on everything we know?
And I would say that we'd try to find data somehow. Like, maybe there's no data for that market, but we look at adjacent markets, and then we'd have to probably make some assumptions like, okay, the rent is slightly lower here as opposed to this neighboring city, so maybe the expense ratio will be slightly higher. But we'd find some data. Otherwise, I don't think Eric or I would invest in a project if there's no data at all.
Well, I think the back end data for rentals is going to be pretty much available. It's really just the construction side of it. If somebody has never gone through a conversion, they're like, where do I even start with figuring out what these numbers are going to run me?
That's actually a really good point, because we, on our first foray into this, Nick, we did kind of almost, we're looking at, okay, we know new construction in Boston. We know what that costs per foot. We know what renovation costs per foot, which is kind of why we had to bring in the contractor during this due diligence period and really get a sense, what are we dealing with here? Because we didn't really know per foot what a renovation like that, when you have an old building that wasn't residential, but you're keeping part of it, you know what I mean? And you might be keeping some of the most, the most expensive components to construct, but you also have to change its use. So we now have an idea roughly, and it is still a pretty wide range on the per foot cost to do something like this, but we've really narrowed it down. So we could look at the next project and say, okay, it's a 50,000 square foot building. We know it'll cost maybe, this much per foot, 140, something like that, for example. How can we make this work? So we've narrowed it down, but it is still definitely a bit more of a wild card on a project to project basis than, say, new construction condos.
The key thing though is, gentlemen, is that you're not just shying away, you're actually taking it on and going forward. You're not saying, hey, I don't have the data, I'm afraid to figure this out. Like, you're locking it up and you're making shit happen. And that's the key takeaway that I want my listeners to hear, is that you're not just putting your hands up and be like, we'll wait until we get on and find somebody that's going to help us. Like, you're making shit happen. So good for you guys. Tell me about the conversion one. How many square foot is the building?
It's about 50,000 square feet.
50,000. And how many units you said you're going to get into that? About 38?
31 residential units, and then 5 retail tenants first floor. And then there'll be a couple office tenants on the second floor. We haven't, it'll either be a large office space or a couple smaller office spaces.
What's the expected value of that building when it's all said and done?
Do you know that off the top of your head, Eric? I believe around 7-8 million.
Yeah, depending on where caps go, we have a range of like 8 to 9, 9.5, 10. Really, kind of could get as high as 10. We keep seeing cap rate compression over there, so it's
crazy, isn't it?
Yeah.
Give us an idea of what the caps are. What are they trading for in that area?
That area, at this point, I mean, your lowest you're seeing is like 5. You're seeing up to like 6.5 for buildings like this. And then like Boston, this is a satellite city we're talking about of Boston. Right. And then in Boston, you're seeing some sub 4 stuff, which is why we can't really build apartments in Boston. It's tougher.
Yeah, like that's insane. And you know, when you see a building that's stabilized and it's trading for sub 4, it's like, how are the guys who are investing into this on the back end making money at a sub 4? like you know, my view, you got to go in and add value to get to that number, you know, to get to that cap. But to buy it at that cap, it's insane.
Yeah, we've asked ourselves that same question especially, I mean, you're in New York, we're in Boston, so we've been seeing the same thing and asking the same questions. But as developers, it's easier to get that extra value than just buying it, obviously.
Yeah. For sure. All right, so fast forward from you guys. What is your plans? What are you looking to accomplish over the next 5-10 years? Because you're young, you're 32. I'm expecting big things out of you guys.
Yeah, I mean, so we really like this office conversion strategy. We put another offer on another similarly sized one last week, so we'll see how that goes. We're starting to scout these off market, these older mill buildings, and we're going to keep doing condo conversions. Then another thing that we're doing right now that we haven't touched on is affordable housing. We're doing a smaller affordable housing development project in partnership with the city of Boston. That'll be 7 units. They'll be for home ownership. There'll be 1 rental. And that's our first foray into that world, but we see that as that's going to be a huge thing. You know, it already is. And with the way the cost of living in this area and across the country, even just the cost of rent versus, you know, minimum wage workers, affordable housing is huge, is going to become bigger. So we're getting our foot in the door there, and hopefully we'll be doing some big projects.
Are you gentlemen looking to stay within your area, within the, you know, the Boston area? Are you looking to go out into other markets as you grow?
We're pretty opportunistic. I mean, if we see an opportunity elsewhere, we're okay with exploring it. I mean, we had, for a good part of last year, we were really focused on the southeast of the country, trying to buy much larger, you know, maybe 100+ unit properties that could maybe like Class B, built in the 80s, value add, where we wouldn't redevelop anything, but we'd come in, increase managerial efficiency, try to raise rents, and just kind of maybe do some physical upgrades. But you know, we put in a couple offers. Actually, we didn't get to best and final on all of them, but we were pretty close to taking some down. And what ended up happening was kind of the cap rate compression down in like Florida, North Carolina, Georgia. We were very excited about it, but it happened so fast. You were seeing cap rates that were lower than Boston, and we were like, "Well, you're buying it for 2 years out, assuming you make all these upgrades in that." So we kind of backed off that and have now refocused right in our, you know, neck of the woods a bit more.
I love it. What do you guys? Who do you want to contact you from my podcast? Do you want people who have cash to contact you, invest? Do you want people who are property finders in your area to hit you? Like, who can we have like reach out to you guys and network in your area?
Yeah, I mean, both of those. That's typically, you know, what we're looking for is just to build our network. People are interested in investing in development deals where you can get maybe a bit higher return than a lot of other real estate investments, and brokers who looking to help us find projects. Those are the two big ones.
Tell me, how can they find you guys online?
So we're pretty active on Instagram at Winter Spring Capital, our website, winterspringcapital.com. Tons of articles about development and pretty much everything we've learned since we've been in business. Got some investor guides on there. And then Eric and I are both on LinkedIn, Nick Earls and Eric Dinicola.
I love it. You guys are 2 solid individuals. I can't wait to see you guys grow over the years. And we should stay in touch too, because I'm getting into this business. My fix and flip and wholesale business is on autopilot. And so I'm taking my energy and really focusing in on building out a development side of the business. And my personal goal is 5,000 units over the next 10 years. And I know when I focus on it, it comes to fruition, but I need to focus on it. That's what I'm doing.
Nice. That's a good goal.
Great.
I like it.
Yeah, that's a great goal.
All right, gentlemen. Loved having you guys on. Boston boys, hit them up if you guys have deals in the area. If you have money you want to invest into development projects, Eric and Nick are your guys. Gentlemen, I appreciate you having you on. Good to meet you. Let's stay in touch. I got your cell phones. I'll hit you with a text afterwards. Let's definitely stay in touch.
Billy, thanks so much. Really appreciate it.
That was great.